Now we are going to discuss the reporting requirements under 143 subsection 11, and these reporting requirements also have an other name which we call it as CARO. Company Auditors Report Order, one of the most important from the examination perspective. From the CARO itself, you can expect minimum 4 to 5 marks. You can expect it only from the CARO. So let us try to spend enough of time on revising this CARO reporting requirements. Totally, we have 21 clauses which are required to be reported under CARO. Let us have a quick look at it. Shall we do it now? Right. So my this file is getting a stuck bit. So what I will do is I will close it and reopen it once again so that it will stop getting stuck. Just give me a minute's time. Yeah. So we can resume our discussion. So we are going to revise now CARO 2020. And how many reporting requirements are there under this CARO? We have a total of 21 matters which are required to be reported under this CARO 2020. Before we can revise what are that 21 reporting requirements, first we will try to understand applicability. Listen, this applicability itself is so important that even in the recent examination also, if you observe, there is a question regarding applicability only. So such an important concept is this applicability related matter. So we will try to spend enough of time in understanding or revising this CARO applicability, and then we will spend significant amount of time on revising the reporting requirements. So first we will talk about applicability. See, CARO is actually an additional reporting requirement which is given by central government after consulting with NFRA, National Financial Reporting Authority. Now, this order is applicable for every company, including a foreign company. However, CARO is exempted for certain class of companies. CARO is exempted for certain class of companies. In case if you are conducting audit of certain companies, CARO will not become applicable for you. So what are they, sir? Number one, banking company. If you are conducting audit of a banking company, CARO doesn't apply. If you are conducting audit of an insurance company, CARO does not apply. In case if you are conducting audit of a Section 8 company, non-profit making company, CARO will not apply. It will not get applicable even for 1% company and even a small company. And it is not even applicable for private limited company. It is not applicable for private limited company if the private limited company satisfies 4 conditions. Not any one condition. If the private company satisfies all the 4 conditions, then CARO will not become applicable. Once again, I am repeating, when a private limited company satisfies any one or all 4. When a private company satisfies all the 4 conditions given here, then auditor need not report on CARO for that company. So what are that 4 conditions? So if I list them out, the company, your client company should not be a subsidiary or holding of a public company. Number 2, your client should not have paid up capital and reserves and surpluses exceeding 1 crore rupees as on balance sheet date. Your client should not have borrowings from banks and financial institutions exceeding 1 crore rupees at any point of time during the financial year. And your client company should have a turnover as per Schedule 3, including revenue from discontinuing operations, not exceeding 10 crores during the entire financial year. So if your client company is a private limited company and if it satisfies all these 4 conditions, then CARO does not become applicable. Now, sometimes they have asked a practical question. They will give in the question, so and so company is there, which is a private unlimited company and which satisfies the conditions. CARO applicable or not applicable? They will give you in a question, like for example, even I have included it here for reference. So in this material is a very comprehensive material. We have I have personally put a lot of effort in redesigning and revamping all this material. So please do consider downloading it, and how to download it I have already told you in the description below. Yes. So this is how, assume this is somewhat a kind of examination question. CA Jayesh is appointed as auditor of KP Private Unlimited, a company registered under Companies Act with unlimited liability. For financial year 2020-21, the company had total revenue of 8 crores, which is less than 10 crores. Borrowings from banks and financial institutions is also within the limit of 86 lakhs. Paid up capital and reserves of 97 lakhs. Explain whether this audit report must include CARO. So now if you observe, look at the conditions, all the conditions are satisfied. So the company's turnover is less than 10 crore, borrowings from banks and financial institution is less than 1 crore, and even paid up capital and reserves and surpluses balance is also less than 1 crore. Now, is the CARO applicable or not applicable? CARO will be applicable. Why? Because exemption is there for a private limited company subject to fulfillment of conditions. But in the given case, the client is a private unlimited company. Since the company is a private unlimited company, no need to check for any conditions. CARO will directly become applicable. CARO will be applicable. Exemption is there only for a private limited company subject to fulfillment of conditions. For a private unlimited company, no exemption, nothing, directly CARO will become applicable. So like this also they might pose you a question. So now let us try to understand these conditions in a detailed manner and special points that need to be kept in mind while doing this calculations. Let us try to do it. Sorry. Yeah. So what is the first condition here? First condition, they are saying that your client should not be a subsidiary or holding of a public company, which means if you are conducting audit of a private limited company, that private limited company should not have a holding company, which is a public company. The private company should not have a subsidiary company, which is a public company. Condition number one, in case if your client company is a private limited company, for CARO to be not applicable, first condition is your client company should not have a holding company, which is a public company. Your client company should not have a subsidiary company, which is a public company. Condition number one. Second condition, your client paid up capital and reserves and surpluses should not exceed 1 crore. That means it shall be less than or equal to 1 crore. Even if it is 1 crore is also fine, but paid up capital and reserves and surpluses shall not exceed 1 crore even by 1 rupee also. Now some special points to be kept in mind while doing the calculation. When I say paid up capital, equity share capital also will be considered, paid up preference share capital also will be considered. And when I say reserves and surpluses, all kinds of reserves will come here. Capital reserves will come, revenue reserves will come, revaluation reserve will come, and even statutory reserves like CRR, DRR, all these things will come. So all kinds of capital is required to be considered. All kinds of reserves and surpluses are required to be considered. Sometimes there will be a debit balance in the P&L account. If there is any debit balance in the P&L account, that could be adjusted again as a credit balance for the purpose of calculation of reserves. Like for example, assume reserves and surpluses credit balance is some 80, but there is a balance in the P&L. P&L debit balance is 20. So this 20 can be adjusted again as this 80. Sometimes what will happen is, even after adjusting again as the credit balance of the reserves, there will be excess debit balance left in the P&L account. If I give you one typical example, the company is having paid up capital of 120 lakh rupees. In the reserves and surpluses category, they have credit balance of the reserves, which is 20 lakh rupees, whereas they have a debit balance in the P&L of 50 lakh rupees. Now, out of this debit balance in the P&L, only 20 could be adjusted again as the reserves. Even after that, 30 lakh rupees of excess debit balance is left out. Can this be adjusted again as the paid up capital for the purpose of calculation? Yes, it can be adjusted. So excess debit balance in the P&L can be adjusted even again as the paid up capital also for the purpose of calculation of paid up capital and reserves and surpluses. So these special things you have to keep in mind. Understood? Now coming to the third point, borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Very important thing, at any point of time. Now there are some special points which we need to pay attention here. Borrowings from only banks and financial institutions are required to be considered. Borrowings from individual person, all these things will not be considered. Borrowings only from banks and financial institutions will be considered. When I say borrowings, they could be short-term borrowings, they could be long-term borrowings. Every borrowing should be considered. And frankly speaking, even credit card outstanding amount is also required to be considered. All kinds of balances, short-term, long-term, every kind of borrowing, or even that could be secured, unsecured, every kind of borrowing you have to consider. And you should not see the borrowings amount only as on balance sheet date. At any point of time, the borrowings shall not exceed 1 crore. At any point of time. During the year, even for 1 day also, if the outstanding balance of borrowings has exceeded 1 crore rupees, CARO will become applicable. Like for example, a typical example I will give you. 21-22 financial year, opening date 1/1 1/4/2021, borrowings from banks and financial institutions 70 lakh rupees. As on 30th of June 21, the company has taken additional borrowings of 40 lakh rupees. During the current year, the company repaid some borrowings to the extent of some 50 lakh rupees. As on the balance sheet date, that is as on 31st of March 2022, the closing balance is 60 lakh. CARO becomes applicable or not? Yes, it becomes applicable. Why? Because from 30th of June till 30th of September, the outstanding balance is 110 lakhs, which has exceeded 1 crore rupees. CARO becomes applicable at any point of time is very, very important. But when you are checking paid up capital and reserves and surpluses, you need not be concerned at any point of time. Paid up capital and reserves and surpluses balances shall not exceed 1 crore only as on balance sheet date. During the year, anything can happen, but paid up capital and reserves and surpluses balance shall not exceed 1 crore only as on balance sheet date. But for borrowings, at any point of time during the financial year. And few more things here. When I say borrowings, all kind of borrowings are required to be considered. This I have already told you. And one more thing here. This limit of 1 crore is for all banks and financial institutions put together. Collectively, the total borrowings from all banks and financial institutions shall not exceed 1 crore. It should not be like for each bank and financial institution 1 crore of limit. No. The cumulative balance of borrowings from all banks and financial institutions shall not exceed 1 crore. Not for individual banks separately 1 crore limit is given. Now, fourth point, the total revenue of the company shall not exceed 10 crores, should be less than or equal to 10 crore rupees. Now, while calculating this, the special points which you need to keep in mind is revenue from discontinuing operations also should be added. If in the question they are saying revenue from discontinuing operations, that shall be added for that revenue. And from this total revenue, only 3 things are permitted to be deducted. One is sales returns are to be deducted. If there is any trade discount, trade discount also can be reduced, and along with that, even GST or other tax components also can be reduced. But sometimes in the question they will give you something like this: total revenue of the company 11 crores, GST collected and accounted separately. They will ask you this also: GST collected and accounted separately 1 crore rupees. Now what you will consider for calculation? Will you consider the figure as 11 crore rupees, or will you adjust that 1 crore and consider it as 10 crore? You have to consider 11 crores only when you see the phrase GST collected and accounted separately. The meaning of this sentence, GST collected and accounted separately, is the given turnover does not include the GST component. That's what it meant. See, when the given turnover does not include GST component, why we will deduct it once again? So like this, if you find this terminology, GST collected separately, excise duty collected and accounted separately, that means that the given revenue figure is already exclusive of taxes. We should not reduce it once again. Clear? So these are the things which needs to be kept in mind while calculating total revenue. So keeping all these things in mind, we need to check for these limits in the case of a private limited company, and if all conditions are satisfied, then CARO becomes not applicable. If any of the condition is violated, then CARO becomes applicable. And one more thing, in case of holding company will prepare 2 sets of financial statements: standalone financial statements and consolidated financial statements. Limits will be calculated only as per standalone financial statements, not consolidated. And while conducting audit of consolidated financial statements, CARO is exempted except one clause, which is clause number 21. If you are conducting audit of consolidated financial statements, your audit report need not include the 20 clauses. Only clause number 21 should be mentioned in consolidated financial statements. In case if the company is having branches, then the limits will be calculated for the company as a whole, including all the branches information. And once CARO becomes applicable for the entire company, all the principal auditor, branch auditor, everybody have to report on this 21 matters in their respective audit reports. Understood? So this is what calculations, applicability criteria. Very important, as I have told, sometimes questions will be tested from this applicability criteria itself. Now let us come to the reporting requirements. What are those 21 matters which are required to be reported? That we will try to understand. First reporting requirement is regarding property, plant and equipment. Regarding property, plant and equipment, you need to check 5 things. How many things? 5 things. Number 1, you need to check whether your client is maintaining proper records relating to fixed assets. Sorry, PPE. Whether your client is maintaining proper records relating to PPE, which should show quantitative details of PPE, situation of the PPE, nothing but location of the PPE. So whether your client is maintaining such a records, which should show me quantitative details as well as situation or location of PPE. Number 2, whether those fixed assets are physically verified by the management at reasonable intervals. Whether your client company has physically verified. They're not asking auditor to do physical verification. They're asking whether management did the physical verification of that PPE at reasonable intervals. Here at reasonable intervals means once in 3 years. For PPE physical verification, reasonable interval can be taken as once in 3 years. And on doing such physical verification, did the management find out any material discrepancy? Any differences were found out by doing that physical verification? If yes, whether they have been properly dealt with in the books of accounts, whether they have been properly adjusted in the books of accounts. So this is the second point regarding physical verification. First point is regarding maintenance of records. Second point is regarding physical verification. Number 3, we need to check titles of immovable properties. Nothing but whether your client is a true owner of the immovable properties or not, I need to check. Sir, how can I check the title of immovable properties? Simply by checking the registration documents, by checking the sale deeds. So whatever land and buildings are there in your client's balance sheet, get the registration documents of all these land and buildings, check whether in the registration document company's name is there or not. If company's name is not there, that means in the registration document, if somebody else's name is there, then I need to report some details. What are they? Description of the property, describe about that property, what is the gross carrying value. If not in the company's name, then it is held in whose name, whether that person in whose name the property is held, is he promoter, director or employee, for what period the company is holding, the asset, and the reason why it was not yet transferred in the name of the company. These reasons are required to be reported in case if the property is not in the name of the company. If it is there in the name of the company, no issue. Now, coming to the fourth point, during the year, whether your client company did any revaluation of the assets. Revaluation means restating the assets. In case if your client has done the revaluation of the assets, whether the revaluation is based on valuation done by a registered valuer. Whatever figure comes to your client's management should not be revalued. The company should go to a registered valuer, get the valuation certificate. As per that valuation certificate, revaluation should happen. So I need to check whether revaluation is based on a certificate from registered valuer. And also specify the amount of change. You need to mention how much amount of change has happened because of revaluation only if the change is 10% or more in the aggregate of net carrying values of each class of property, plant and equipment. Which means you need to tell the amount of revaluation only if because of revaluation the change is 10% or more. Not for individual asset, for aggregate value of entire class of assets. So what do I mean by here is, I will give you one best example to make you understand, very, very important. Assume company is having some buildings under buildings category. 3 buildings are there. Building 1, building 2, building 3. I will give you values before revaluation. I will give you values after revaluation. So before revaluation, the building 1 is having a value of 100 crore rupees. It was revalued to 115 crores. Building 2 is having a value of 50 crore rupees. It was revalued to 53 crores. Building 3 is having value of 100 crore rupees. It was revalued to 87 crore rupees. Now you tell me for which asset I need to mention the amount of revaluation. Will you say here, sir, here change is 15 crores, more than 10% before revaluation. 10% is 10 crores only. Revaluation is more than 10% here. Here only 3 crores of revaluation, less than 10%. Here 13 crores of difference of revaluation, which is also more than 10%. Will you say I will report the amount of change for building 1 and building 2? You are absolutely wrong. You are completely wrong. You are required to tell the amount of revaluation if the change is 10% or more, not for individual asset. If the change is 10% or more, for the aggregate of entire class of PPE. For what? For aggregate of entire class of PPE. So what do I mean here? You need to check the value before revaluation or after revaluation for entire class of buildings, not for individual buildings. So if I do the totaling here, it will be before revaluation, entire buildings was 250 crores. After revaluation, the buildings value was somewhere around 255 crores. If I am not wrong, correct me if I am wrong with the calculations. So I guess so it is 255 crores. So there is, for the entire buildings category, there is only 5 crores of change because of revaluation, which is hardly less than 10%. Here 10% is only 25 crores, but the effect of revaluation is only 50 crores. No amount is required to be reported. Clear everybody? So fourth point is regarding revaluation, whether your client has revalued any of the property, plant and equipment. If so, whether that revaluation is on the basis of registered valuer certificate, and because of that revaluation, if the change is 10% or more, that too in the aggregate of total value of each class of property, plant and equipment, specify the amount of change also. Next, last point regarding PP, whether any proceedings have been initiated or are pending against the company for holding Binami properties. Whether any case has been filed against your company, or whether any case is already going on against the company for holding Binami property. If yes, whether the company without hiding disclosed the details of that proceedings in the financial statements or not, that I need to comment. Once again, I am telling you here also, the CARO is not asking auditor to disclose the Binami transactions. The CARO is asking auditor to check whether management disclosed the Binami transaction cases in their financial statements. I'm repeating it once again. In this case also, the CARO is not asking auditor to disclose the Binami transactions in his audit report. They are just asking the auditor to check whether company disclosed the details of Binami transactions in their financial statements or not. Clear? So this is the first reporting requirement, PPE. Regarding that, 5 points are there. Number 1 is regarding proper record maintenance. Number 2, whether physical verification done by the management. Number 3, title of the immobile properties are held in the name of the company. Number 4, whether any revaluation happened. If yes, on the basis of registered valuer. If the change is 10% or more for each class of asset, mention the amount. Number 5, whether company disclosed the Binami transaction cases in their financial statements or not. That's all. This is the first point. Second point is regarding inventory. Regarding inventory, what I need to do? First, here also I need to check whether physical verification of inventory has been done by management, not auditor. They're not asking auditor to do physical verification. They're asking whether management did the physical verification of inventory at reasonable intervals. Here, reasonable intervals means once in every year. For physical verification of inventory, reasonable interval means what? Once in every year. And whether the coverage and procedure of such verification is appropriate. Whatever coverage management has done, whatever procedure management has followed for doing that physical verification, is that appropriate or not, you have to give the comment. And whether any differences of 10% or more, here also for aggregate of each class of inventory were noticed. For every class of inventory, if you find difference of more than 10%, then you need to mention that amount, and also you have to tell whether it has been properly dealt with in the books of accounts. See, when I say classes of inventory, when it comes to inventory, there will only be 4 classes: raw material, work in progress, finished goods, stores and spares. So if there is 10% or more difference you are able to find for total of each class of inventory, then only you need to report that difference. If the change is there but less than 10% discrepancy is there for entire class of asset, then you need not report that discrepancy. Next, working capital loans. Second point is regarding, in case your client at any point of time during the year, whether your client has taken working capital loan in excess of 5 crore rupees, giving security of current assets. Second reporting requirement is applicable in case your client company has taken loans. That to which kind of loan? Working capital loan. That too for an amount exceeding 5 crores at any point of time during the financial year. And what they have given as security for this working capital loans? Current assets, mainly stock. So in case if your client has taken any working capital loan in excess of 5 crore rupees from banks or financial institutions, giving the security of current assets, then I need to check whatever quarterly stock statements which my client company is submitting it to the banker, are they submitting genuine stock statements? That means, are those stock statements are in agreement with the books of accounts of the company, or if they are submitting wrong stock statements to the banker, that also I need to check. So this particular point is included to protect the interest of the bankers. Clear everybody? So that is what the second point is about, whether your client has taken any working capital loan, that too in excess of 5 crore rupees at any point of time during the year. If yes, they will generally submit quarterly stock statements to the banker to make the banker aware of what is the current status of the stock. As an auditor, I need to check whatever quarterly stock statements which my client company is submitting to the banker, whether they are matching with the books of accounts. That is, whether they are submitting genuine stock statements or they are submitting fake stock statements. That I need to have a look and give a comment on that. Clear everybody? So 2 reporting requirements we are done. We are left with 19 more. So let us have a look at them now also. Now we will go to point number 3. So point number 3 is talking about investments, guarantees, security, loans or advances given by the company. So this third point is regarding loans and advances which are given by the company to others. That means this is also talking about assets of the entity, the loans which your client company has given to others. So now in this also 6 points are there. Let us try to understand them. First one, you need to find out whether your client company has given loans to any of the related parties. So third sub point we are dealing in that 6 points will be there. Point number A, you need to check whether your client company has given any loans and advances or investments or guarantees to any of the related parties. If yes, we need to segregate how much amount of loan was given, aggregate amount of loan given, and balance outstanding for subsidiaries, associates, and joint venture. We have to report that separately. For other than subsidiary, associates, and joint ventures, that I need to mention the amount separately. Whether your client has given loan to any of the related parties, if yes, I need to divide aggregate amount of loan given during the year, balance outstanding at the end of the year, for subsidiary, associate, joint ventures separately, for other than subsidiary, associate, joint venture separately. Like for example, the company has given loans of total 100 lakh rupees. Out of that, to total 10 entities the company has given the loan. Out of that, 4 subsidiary, associate, joint ventures are there. So the company has given total loan of 100 lakhs to 10 entities. Out of the 10 entities, 4 entities are having a relationship of subsidiary, associate, joint venture. Remaining 6 are other than subsidiary, associate, joint venture. Now I need to divide out of this 100 lakh rupees of loan, how much was given to subsidiary, associate, joint venture. Assume 60 lakhs was given. How much has been given for other than subsidiary, associate, joint venture? 40 lakh. Not just that, what is the balance outstanding as on the balance sheet date? So they have given loan during the year, but during there some repayments, all that things also would have happened. I need to even report what is the balance outstanding as at the end of balance sheet date from subsidiary, associate, joint venture. Assume it is 50 lakh rupees. And what is the balance outstanding for other than subsidiary, associates, joint venture? Assume it remained the same 40 lakh rupees. So like that, in case if my client has given loans to any of the related parties, I need to divide aggregate amount of loan given and balance outstanding for subsidiary, associate, joint ventures separately and other than subsidiaries, associates, joint ventures separately. Clear? Second point. This is the first point that I tried to summarize here. Second point, I need to check under whatever terms and conditions the loans are given, whether those terms and conditions are they prejudicial, are they harmful to the company's interest. This point we have already covered under 143 subsection 3. They are saying you to check the same thing here also once again. Under whatever terms and conditions your client has given loans to that other parties, are those terms and conditions are genuine or are they harmful? I already gave you examples when the terms and conditions will be considered as harmful, when they will be considered harmful. So if they have been given without charging any interest, without repayment period, without any accepting of security, then they will be considered as prejudicial or harmful. Next, third point, it should not be like just your client has given the loan and ignored it. As an auditor, even I need to check whatever loans that have been given to others, whether repayment of principal and payment of interest is happening regularly on or before the due dates, whether your client, whether the third parties, whoever have taken the loan, whether they are repaying the principal and interest on or before the due dates or not, that also I need to check and give a comment. And if at all, any amount remains overdue for more than 90 days. If your client has given loan to other party and if the other party is not repaying the loan, if it has remained overdue and if it remains overdue for more than 90 days, I need to check whether management has taken reasonable steps for recovery of the principal and interest. Whether the company has taken reasonable steps for what? For recovery of principal and interest. What could be reasonable steps? Selling the security, filing a case on them, etc. Whatever it is, reasonable steps are taken by the management for recovery or not, I need to check. Then we have rescheduling or extension of the loans, which means your company has given some loan in the past and that loan has fallen due during the year. In the current year, the due date is there. When the due date is in the current year, your client should have collected the money. But instead of collecting the money of the loans which have fallen due, what your client is doing is they are either renewing it or they are extending it or the fresh loan is given to the same party to settle the old loan. Did you find any of these transactions? Your client has given loan in the past which has fallen due in the current year, but instead of collecting the loan which has fallen due, they are either extending or renewing it. That means they are extending the due date, or for the same party they are giving a new loan. Out of that new loan, he is repaying the old loan. Nothing but indirect way of extending only. So did you find whether your client has conducted these kind of transactions? Instead of collecting the loans, they are renewing, extending, or fresh loans are given to same party. If yes, I need to report what is the total amount of such loans which are renewed, extended, or settled by fresh loans. The total amount of loans I have to report. Along with that, I need to calculate percentage with the total loans and advances. Like for example, the total loans are 100. Out of that, 40 lakh rupees of loans are in the nature of renewal, extension, and fresh loans. So percentage, if you calculate, that will be 40%. That percentage also I need to calculate and report it here. Clear? However, this particular point is not applicable in case if you are conducting audit of such a company whose principal business is to give loans. Nothing but in case if you are conducting audit of banks and financial institutions, this reporting requirement does not apply. For banks, CARO itself will not be applicable. Even if you are conducting audit of any NBFC, then you are not required to report on this matter. Not just this point, even the first point also, this loans to related parties. I told you that segregation, aggregate amount and balance outstanding. That first point is also not applicable in case if you are conducting audit of such a company whose principal business is to give loans, whose main business is to give loans. That is, for banks and financial institutions, you need not report on this matter. And one more last point under this third point, whether your client has given any demand loans. Demand loans means your client is giving loan without mentioning any repayment period. So in case if you find out that your client is giving the loans without mentioning any repayment period, you need to mention in the audit report what is the total amount of such loans given without repayment period. Here also calculate the percentage, how many total loans are there, out of that how much percentage is in the form of demand loans, that calculate the percentage also. And along with that, tell how much amount has been given to promoters and related parties. Out of the total loans, how much demand loans are given to promoters and related parties, that also you need to mention. So coming to the third point, 6 sub points are there which we have seen. Number 1, in case if your client has given loan to related parties, divide between subsidiary, associate, joint venture other than subsidiary, associate, joint venture. Second point, whether the terms and conditions are prejudicial. Third point, repayment of principal and interest is happening regularly on or before due dates. Number 4, if amount is overdue for more than 90 days, reasonable steps are taken by the company for recovery of the principal and interest. Number 5, when the loan has fallen due, instead of collecting it, whether your company has renewed, extended, or fresh loan given to same party. If yes, mention the total amount and also calculate the percentage. Last one, whether your client has given loan without mentioning any repayment period. This is what we call it as demand loans. If yes, mention the total amount of such demand loans. Here also calculate the percentage and report it. That's all. This is what the third reporting requirement. Now coming to the fourth one, very simple. Fourth point is also regarding loans, investments, guarantees which are given by the company. In the fourth point, they simply says that if your client has given any loan, investment or guarantee to other parties, check whether they are giving it after complying with the section 185 and 186 of the Companies Act. That's all. Fifth point, acceptance of deposits. In case if your client company has accepted deposits, whether they complied with section 73 to 76 of the Companies Act. And regarding that acceptance of deposits, if there are any directives or instructions given by RBI, whether they are complied with or not. And if there is any order of CLB, that is Company Law Board, Court or Tribunal regarding that deposits, whether those are complied with or not. Very simple. In case if your client has accepted any deposits, provisions of the Companies Act, RBI instructions, court order, whether all these are complied with or not, I need to check. If you find any non-compliance, report what is that non-compliance which has happened during the year. Next one. Sixth point, maintenance of cost records. Nothing but whether your company is coming under that applicability criteria given under section 148 subsection 1. If yes, whether your client is maintaining cost records or not. That's all. Whether for your client cost records are applicable. In case if cost records are applicable, whether your client is maintaining proper cost records or not, you have to comment on that. Next, seventh point, important point, which is regarding statutory dues. First of all, what is the meaning of statutory dues? Statutory dues means those amounts which are required to be paid because of the requirement of law. You are required to pay some amount because of requirements of law. Examples, income tax, GST, PF, ESI, gratuity. So these all will come under statutory dues. And regarding the statutory dues, there are some reporting requirements. And for the purpose of auditors reporting requirements, statutory dues are divided into two categories, undisputed and disputed. So what is this undisputed and disputed? Disputed dues means there is some case going on between your client company and the regulatory authority. That's why some tax amount was not paid. That is disputed. Undisputed means there is no issue, nothing, no one is challenging. So, but still your client did not pay the money. That is undisputed. So, if your client is fighting a case with the regulatory authority regarding one statutory due, that is a disputed due. If there is no case, nothing going, then that will be an undisputed statutory due. So now what are the reporting requirements relating to statutory due? What are the reporting requirements relating to, what are the reporting requirements relating to undisputed? What are the reporting requirements relating to disputed? So first we will talk about undisputed dues. When it comes to undisputed dues, I need to check whether my client company is regular in depositing all the undisputed statutory dues with the authorities. If there is no dispute lying, my client should have paid all the undisputed statutory dues regularly. Regularly means what? On or before due dates, whether my client company is depositing all the undisputed statutory dues with the regulatory authorities or not. If not, the extent of arrears outstanding, if you find some undisputed statutory dues was not paid, then I need to report extent of arrears of outstanding dues, nothing but amount of that outstanding dues as at the last day of the financial year concerned for a period of more than 6 months from the date they become payable shall be indicated by the auditor. So what they are trying to say here, is if at all any undisputed statutory due is there which is not paid to the regulatory authorities, and those statutory dues which are undisputed, which are outstanding for a period of more than 6 months as on the balance sheet date, only those amounts are required to be reported. Once again, I am repeating, not all the undisputed statutory dues outstanding shall be reported. Only those undisputed statutory dues which are outstanding for a period of more than 6 months as on the balance sheet date are only required to be reported. Let me make it simple with the help of example. Assume your client is required to pay some GST. No dispute, nothing. The due date is 31st of January 2022. But your client did not pay till balance sheet date, 31st of March 2022. The amount is 10 lakh rupees. Is this required to be reported? No. Why? Because even though amount is outstanding, it is outstanding for less than 6 months. It is hardly 2 months. Another amount is there. They are required to pay some PF amount. Amount is 20 lakh rupees. The due date is 30th of June 2021. They did not pay it till 31st of March 2022. Is this amount required to be reported? Yes. Why? Because the amount is outstanding for more than 6 months as on balance sheet date. Clear? So this is what the reporting requirements relating to undisputed. Now coming to disputed statutory dues, in case of disputed statutory dues, auditor is required to comment on two things. What is the amount involved in the dispute, and the forum and the court or authority where the case is pending. What is the amount involved in the dispute, and the court when the court or commissioner before which the case is pending. Is it pending before commissioner? Is it pending before court? Is it pending before is it pending before tribunal? Is it pending before Supreme Court, High Court? That need to be mentioned. So two things regarding disputed dues: what is the amount involved in the dispute, and the forum where the case is pending. So this is what regarding statutory dues. Coming to 8th point, disclosure of undisclosed income. In this point, what they try to say here is, during the year, whether your client company has faced any income tax assessment. During the year, whether any tax assessment happened, like income tax raid or return taken up for scrutiny. So like that, whether any tax assessment happened. And as a part of the tax assessment, has your client surrendered or disclosed some previously unrecorded income? Like some income tax raid happened, and in that raid, your client has surrendered some income which he did not offer to taxation earlier. So like this, during the year, whether the client has surrendered or disclosed income as a part of tax assessments. Now as an auditor, what I need to check is, now if you are surrendering for taxation, you would not have recorded in the books also. You would have hidden that income from the books also, whatever you are surrendering now. So just surrendering before the tax authorities alone will not be enough. That unrecorded income, whether it is now recorded in the books of accounts or not, that I need to check. What they are trying to say, if as a part of tax assessment, whether any income is surrendered or disclosed to the tax authorities now, just surrendering to the tax authorities alone will not be enough. That income should have been now brought to the books of accounts also. So I need to check whether that previously unrecorded income which is offered to taxation now has been recorded in the current year's books or not. That I need to check here. Next, 9th point is regarding loans which are accepted by your client. Now they are talking about borrowings of your client, not the assets. Now they are speaking about liabilities of your client. So when it comes to loans accepted by the client, we need to report on a few points, like whether your client has done any default in the repayment. So has your company defaulted either in the repayment of principal or payment of interest? Now what do you mean by default, sir? Default means either you are not paying the money, or even if you pay the money beyond the due date, that also will come under default. So whether your client company has made any default in repayment of loans or borrowings. If yes, I need to report the period and the amount of default for each lender. Lender wise amount and period of default should be reported, not the total amount of default. For each lender, how much period of default has been made, how much amount of default has been made, that needs to be reported. Next, I need to check whether my client has been declared as a willful defaulter by any bank or financial institution. Willful defaulter is a bad credit rating given to the company. So I need to check whether my client has taken any loan from the borrower and whether any bank or financial institution classified my client's account as a willful defaulter. That I need to check and give a comment. Third one is regarding term loans, where I need to check whether my client has taken a long-term loan, but instead of using it for the purpose which was mentioned to the banker, are they using it for other purposes? So in simple terms, if I have to put it, whether your client has applied the term loans for whatever purpose they have got it, they should not have misused it. In case if they have misused the long-term loans, I need to mention what amount of loan has been used for that other purposes and what is that other purpose for which they have used it, that I need to report. Simply if I have to put it, for whatever purpose long-term loans are taken, whether they are used only for that purpose or not, I need to check and report. Now fourth point is regarding short-term loans. In case if your client has taken any short-term loan, whether it is used only for short-term purposes or it has been used for long-term purposes, that I need to check and give a comment. Then whether your client company has taken loan for meeting obligations of your subsidiary, associate, joint venture companies. Your client has taken loan, but not for meeting your client's requirement, but for meeting obligations of subsidiaries, associates, joint ventures. Then I need to report what amount of such loans are taken for meeting obligations of the subsidiary, associate, joint venture, and for what kind of transactions they have spent it, that I need to report. Clear? Next, last point under this last sub point under this point, loans against pledge of securities or subsidiaries. That means whether your client has taken any loan, but for loan we need to offer security. No, what has been pledged with the banker is the shares which they are holding in subsidiary, associate, joint venture. So whether the company has raised any loans during the year by pledging securities which they are holding in subsidiary, associate, joint venture. Whether your client has got any loan by pledging the shares of subsidiary, associate, joint venture. If yes, give the details like what is the amount involved and how many shares are pledged, etc. And also report whether there is any default in the repayment of such loans taken on the pledge of securities held in subsidiary, associate, joint venture. That's all. So 6 points regarding loans which are taken by your client company. What are they? Whether your client has made any default in the repayment. If yes, amount and period for each lender wise. Number 2, client is declared as willful defaulter. Number 3, whether term loans are used for the set purposes. Number 4, short-term loans are used for long-term purposes. Number 5, loans are taken for meeting the obligations of subsidiary, associate, joint venture. Number 6, whether loans are taken by pledging the securities of subsidiary, associate, joint ventures. That's all. Clear? Now, coming to the 10th point. 10th point is regarding IPO or FPO. So, when it comes to IPO or FPO, they have two sub-points here. Whether your client has raised the money by way of IPO or FPO, including debt instruments. If yes, they will tell some purpose to the investors, no, for so and so purpose we are raising this IPO, FPO. As an auditor, I need to check whatever amount that has been raised from IPO or FPO, whether that amount has been used only for the set purposes. Sir, how will I come to know about the purpose, sir? You will come to know about the purpose from reading the prospectus. So I need to check whatever money that has been raised from IPO, FPO, whether it has been used only for the purposes mentioned in the prospectus. If not, I need to report what defaults have taken place, what delays have taken place, and what subsequent rectifications are done. Everything needs to be reported. Similarly, during the year, if there is any private placement or preferential allotment, the difference between IPO and this preferential allotment is in IPO, FPO, the offer will be open for everybody. But in the private placement of shares will be issued, but only for a limited group of people. So in case if your client has raised money by way of preferential allotment or private placement, I need to check whether they have complied with section 42 and 62 of the Companies Act, which contains rules regarding this preferential allotment or private placement, and whatever amount that has been raised from that private placement, whether it has been used only for the purpose for which it has been raised. If not, if they are used for other purposes, then I need to report what kind of non-compliances have taken place. Now talking about the 11th point is regarding reporting of the frauds. So here what they say is whether any fraud by the company or on the company has been noticed or reported during the year. As an auditor, did you notice or report any fraud by the company or on the company? If yes, you need to mention nature and amount involved in the CARO. What is the nature of the fraud along with the amount needs to be reported in the CARO. Similarly, you need to comment whether any of the auditors submitted form ADT4 during the year. We have reporting requirements under 143 subsection 12. When amount involved in the fraud is 1 crore or more, reporting to central government will happen. So I need to give a comment whether any of the auditors submitted form ADT4 during the year. Similarly, even I need to give a comment whether as an auditor, did you receive any whistleblower complaints during the year? If any, how you have considered them. As an auditor, did you receive any whistleblower complaints and how you have dealt with them? So 3 points regarding the frauds. What are they? Number 1, whether you notice or report any fraud. If yes, nature and amount involved. Number 2, whether any of the auditors submitted form 84. Number 3, as an auditor, did you consider any whistleblower complaints taken place during the year? Next, 12th point is regarding Nidhi company. In case if you are conducting audit of a Nidhi company, you need to check 3 points. Whether net owned funds to deposits ratio is 1:20. Which means for every 1 rupee of net owned funds of Nidhi company, they can accept a maximum of 20 rupees of deposits only. If they have 1 lakh rupees of net owned funds, they can accept a maximum deposits of 20 lakh rupees only. So whether this net owned funds to deposits ratio of 1:20 is met or not, I need to check it. And whether Nidhi company is maintaining 10% unencumbered term deposits. Out of the total deposits which they have collected, 10% should be kept in a fixed deposit, that too unencumbered, without offering any security. So if the Nidhi company has collected total 100 lakh rupees of money, in that 10%, which will be 10 lakh rupees, that 10 lakh rupees should be kept in a fixed deposit, and that fixed deposit should not be offered as a security for any loan. So whether 10% has been kept in unencumbered term deposits or not, that I need to check. And finally, whether Nidhi company has made any default in repayment of principal or interest to any of the deposit holders. So 3 things I need to comment in case if my client is Nidhi company. Sir, what if my client is not a Nidhi company? I will mention the same fact. My client is not a Nidhi company. Reporting requirements under this clause will not be applicable. Next point, 13th point is regarding related party transactions. So in case if your client has entered into any related party transaction, you need to check whether those related party transactions are as per section 177 and 188 of the Companies Act. And regarding related party transaction, there are so many disclosure requirements as per accounting standards. I need to check whether all those disclosure requirements are given in the financial statements or not. That's all. Compliance with Companies Act, disclosure requirements as per accounting standards. 14th point is regarding internal audit system. I need to comment whether your client is having internal audit system which is commensurate, which is matching with the size and nature of the business. Nothing but whether your client company is having enough of internal audit team which is matching with the size of the company, that I need to comment. Along with that, as an external auditor, did you use the reports of internal auditors? That also you need to give a comment. As an external auditor, did you make use of internal auditor's report? That also you have to comment in your audit report. And finally, non-cash transactions. Whether the company has entered into any non-cash transactions with the directors. Did the company enter into any exchange of goods and services, barter transactions? So I need to check whether company has entered into any non-cash transactions with the directors and other related parties. If yes, whether the provisions of section 192 of the Companies Act are complied with or not. So section 192 will give you some rules and regulations regarding non-cash transactions with the directors or related parties. I need to check whether that section 192 has been complied with or not. Next one, NBFCs. If I am conducting audit of a non-banking financial institution, then I need to check. Then I need to comment on certain points. Whether my client company is required to obtain registration under 45(1)(a) of the Reserve Bank of India Act. 45(a) of the Reserve Bank of India Act. So some NBFCs are required to get necessary registration under this particular section of the RBI Act. I need to check whether my client is getting covered under that section of the RBI Act. If yes, whether they have obtained that necessary registration from the RBI or not. Second one, whether my client company is conducting any non-banking financial activities or housing finance activities without obtaining a valid certificate of registration. Did my client company carry out any non-banking housing finance or non-banking or housing finance activities without obtaining registration from RBI? That I need to check and give a comment. And also, in case if your client NBFC is enjoying a status of CIC, CIC is a status given to some NBFC subject to fulfillment of conditions. So in case if your client company is enjoying that status of CIC, core investment company, as an auditor, I need to check whether they are continuing to fulfill the criteria of a CIC. Like for example sake, if NBFC fulfills some 10 conditions, they will get the status of CIC. So if my client is enjoying that status of CIC, I need to check whether these 10 conditions are satisfied or not. Now after becoming CIC, If they fulfill some extra 5 conditions, say some extra 5 conditions are satisfied, then they will get even more advanced status, which we call it as exempted CIC or unregistered CIC. In case if my client is enjoying the status of this exempted CIC also, in addition to these 10 conditions, whether these 5 conditions are also satisfied or not, I need to check. Understood everybody? So that's what they try to say here. If I read it slowly here, whether the company is a core investment company as defined in regulations made by RBI. If yes, whether they fulfill the criteria, whether these 10 conditions are met or not. And in case if the company is exempted CIC, then whether it continue to fulfill additional criteria. If it is exempted CIC, this 10 plus 5, 15 conditions are satisfied or not, I need to give a comment. And also, as a part of your client's entire group companies, is there only one CIC or more than one CIC? That means whether your client's group companies contain more than one CIC, more than one of the group companies enjoying the status of CIC. If yes, how many number of that group companies are enjoying the status of CIC? That number of CICs also I need to mention in my report. Finally, 17th point, cash losses. Whether your client company has made cash losses in the current financial year as well as immediately preceding financial year. If yes, amount of cash losses are required to be reported. Did your client company make any cash loss? See, don't confuse cash loss with loss as per statement of P&L. Both are different. Cash losses have to be calculated from the loss as per statement of P&L, loss or profit as per statement of P&L. So you have to take the figure of profit or loss from the statement of P&L, add back all non-cash expenses, reduce all non-cash incomes. The resulting figure which you get will be called as cash loss. So find out whether your client has made any cash loss for the current year as well as last year. If yes, mention the amount of that cash losses. Next, 18th point says that whether there has been any resignation of the statutory auditors. Did any statutory auditor resign during the year? If yes, find out because of what issues, what objections or what concerns the statutory auditors have resigned and how they are affecting your audit, that you need to give a comment. Just check whether any of the auditors resigned. If yes, find out what issues, what objections, what concerns are raised by them and how they are affecting your audit, that you need to have a comment here. And then finally, 19th point, in which they say that, I will give you summary what they say in the 19th point. In the 19th point, they ask the auditor to tell his opinion whether company is able to pay the liabilities which fall due within a period of 1 year, or is there any uncertainty existing. As an auditor, you need to tell your opinion. Is the company is having capability to pay all those liabilities which fall due within the next 1 year, or are they having uncertainty? Are they having any doubtfulness? Is there any doubtfulness regarding the company's ability to pay? That opinion I have to express. See, because of this particular point in the CARO, I need to comment on the future of the company. So but however, it is just an opinion, not a guarantee. So you should express your opinion. Is the company, so let me read this point in a detailed manner, whether the auditor is of the opinion that no material uncertainty exists as on the date of audit report, that company is capable of meeting all its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So whatever liabilities are there which fall due within 1 year from the balance sheet date, is the company in a position to pay all that liabilities, or is there any material uncertainty existing? That I need to comment here. And on what basis I have to give this opinion, sir? On the basis of calculating financial ratios, on the basis of analyzing expected dates of realization of financial assets and payment of financial liabilities, on the basis of information accompanying the financial statements, and even on the basis of auditors' knowledge of board of directors and management's plans for the future. So you have to consider all this. So by calculating some ratios, by analyzing the dates of realization and payment to the assets and liabilities, by using the financial statements, and by sitting with the management and discussing the plans with them, using all this information, you have to tell your opinion. Is the company in a position to pay all their liabilities as on balance sheet date, or is there any material uncertainty existing? Clear? Now 20th point is regarding CSR expenditure. Let me try to summarize this, what they try to say here. Regarding CSR expenditure, they say two things. Assume 21-22 financial year, the company is required to spend some CSR expenditure. Assume 2% of average net profits of the last 3 years. That 2% comes to 2 crore rupees. In the first point, they ask me to check if the company is not able to plan how to spend this 2 crore rupees of money within 6 months from the end of financial year, that amount is required to be transferred to the fund specified under Schedule 7. Now, what does that mean? With the help of example, we'll try to understand. Financial year 21-22, they calculated CSR expenditure 2 crores they have to spend. Now, company is designing project. Out of this 2 crores, 50 lakhs they will give it as a donation to orphanage. Another 50 lakhs they will give it as a donation to old age home. Some 80 lakh rupees they will use it for the construction of school. A school they will construct. So this is what they have decided. Within 6 months from the end of financial year, from 31st of March 2022 till 30th of September, they are able to decide these projects. But if you observe, the total projects which they have decided is amounting to only 1.8 crores. But how much amount they have to spend? 2 crores they have to spend. So they are unable to decide. They are unable to have a project for that excess 0.2 crore rupees. That 20 lakh rupees they are not able to decide any project. And 6 months from the end of financial year is over, but still they don't know how to spend this 20 lakh rupees. Now this 20 lakh rupees should be transferred to a fund specified under Schedule 7. Sir, examples of the funds specified under Schedule 7. So examples of the funds specified under Schedule 7 are, one is PM CARES Fund, other one is Prime Minister's National Relief Fund. So like that, so many funds are there which are given to which are prescribed under Schedule 7. You need to transfer that money to the fund. Which money? The money which you are not able to plan. 6 months over from the end of the financial year, but still you are not able to plan how to spend that. So that money you have to give it to the fund. That means you are, by transferring the fund, you are giving that money to the government. Government will take care of it, how to spend. If you are able to spend it on your own, come up with a project within 6 months. If you don't come up with a project within 6 months, transfer that money to the fund, and that fund will be utilized by the government for public welfare. So that is what the first point in respect of other than ongoing projects. That means if you don't have any project, the company should have transferred that unspent amount to a fund specified under Schedule 7. If you are not able to have any project regarding the CSR expenditure, you should transfer that money to a fund within a period of 6 months of the expiry of the financial year. Within 6 months from the end of the financial year, you should have transferred that money to the fund. Once the money goes to the fund, company will lose control over it. Government will take care of it. Now, second point is regarding a project. You have a project ready, but you did not spend it. Take for example, this example only we will take. Total 1.8 crore rupees, you have a plan ready. 20 lakhs you have transferred it to government. So out of this 1.8 crores rupees, 50 lakhs you want to give it as a donation to orphanage. The company has written a check, given it immediately. 50 lakhs they want to give it as a donation to old age home. They have written a check, given it. And finally they have 80 lakh rupees. They want to construct a school. But as we know, school construction will not happen in a day or two. It will take significant amount of time. So 80 lakh rupees, you have a project ready, but you did not spend it. You will spend it. 80 lakh rupees, you will spend it on school construction only, but it will take some time. So that money which you did not spend relating to an ongoing project, that should be transferred to a special account. Nothing but a separate bank account you have to open, and in that bank account you have to keep this money. See, when you transfer that money to the bank account, in the second case, company only will have control over it. Company only will spend it. For what purpose they will spend it? For social welfare only they will spend it. But just for segregating the normal funds with CSR funds, they are asking you to transfer this 80 lakh rupees to a separate bank account. So you have a project ready, but you did not spend the money yet. You will spend it in the future. Slowly you will spend it. But till the time you spend it, keep it in a separate bank account. But what is the first point? You don't have a project at all. Since you don't have a project at all, you have to transfer it to the fund. That means you have to give it to the government. Clear? So these two things I need to check. If I read the B point now, whether any amount remaining unspent relating to any ongoing project, pursuant to any ongoing project. That means you have a project ready, but you did not spend it. That money has to be transferred to a special account. That money has to be kept in a separate bank account. Clear? And then finally comes the 21st point. This will come only in the audit report of consolidated financial statements. Here what they simply say is, whatever company's information which is getting included in the consolidated financial statements. So as we know, consolidated financial statements includes holding company, subsidiary company, associate company, joint venture company. You need to go through individual audit reports of all these companies which are included in the consolidated financial statements. Particularly, you have to go through CARO reports of all these companies and find out in any of this company's CARO report, is there a negative remark? If yes, I need to mention in the consolidated financial statements audit report which company contains that negative remark and which paragraph contains a negative remark that I have to mention. So while conducting audit of consolidated financial statements, the auditor should go through individual audit reports of all those companies which are included in the consolidated financial statements, find out whether there is any negative remark. If yes, In the consolidated financial statements audit report, he should mention which particular company's audit report contains a negative remark and which paragraph contains a negative remark that needs to be mentioned in the audit report of consolidated financial statements. So this is what point number 21. So whether there have been any qualification or adverse remark by the respective auditors in the CARO reports of the companies which are included in consolidated financial statements. If yes, indicate the details of the companies along with the paragraph numbers of the CARO report. Clear? So this is what 21 clauses of the CARO are. Understood everybody? And one more thing here, all these 21 matters are required to be reported whether or not you have positive responses or negative responses. In all the cases, you have to report on all the 21 matters.